Hello and welcome back to the Financial Freedom Show. Today we're going to explore one of the most powerful yet often overlooked strategies for building lasting wealth and securing your retirement. Imagine this, over 80% of active fund managers, those professionals who are supposed to have all the inside knowledge and expertise, actually fail to outperform the market over the long term. Despite this, millions of investors continue to pour their hard-earned money into actively managed funds, hoping to beat the odds. But here's the truth. Investing doesn't have to be complicated or stressful. You don't need to spend countless hours researching stocks, analyzing market trends, or worrying about the latest economic headlines. What if I told you that there's a simpler, more reliable way to grow your wealth, one that has consistently outperformed most active strategies over time? A way that allows you to sleep soundly at night knowing that your money is working hard for you without constant intervention. That's where index funds come in. These unsung heroes of the investment world offer a straight path forward to financial freedom, with the potential to provide steady, market-matching returns, all while keeping costs low and your portfolio diversified. In today's episode, we're going to cover what exactly are index funds, and why they might just be the ultimate tool for achieving your long-term financial goals. We'll explore why they work, why they're so effective, and how you can use them to build a rock-solid retirement plan. We'll explore several versions of index funds and bonds, as well as other funds that you can add to your portfolio. Whether you're just starting your investment journey or looking for ways to optimize your existing portfolio, stick around because this could actually be a game changer that you've been searching for on your path to financial freedom. Now that we've set the stage, let's dive into the concept that could fundamentally change the way that you think about investing: index funds. If you're new to investing, or even if you've been at it for a while, you might have heard the term index fund thrown around. But what exactly is an index fund, and why is it such a powerful tool for building wealth? At its core, an index fund is a type of mutual fund or exchange-traded fund, or ETF, designed to mimic the performance of a specific market index. But what exactly does that really mean? Let's break it down. A market index is a collection of stocks or bonds that represent a particular segment of the financial market. The most famous of these is probably the S&P 500, which includes 500 of the largely traded public companies in the United States, from giants like Apple and Amazon to companies like Coca-Cola and Johnson & Johnson. When you invest in an S&P 500 index fund, for example, you're essentially buying a tiny piece of each of those 500 companies all in one easy package. This means that rather than betting on a single stock, like hoping that Apple's next product launch sends its stock soaring, you're spreading your investment across the entire market. If one company in this index underperforms, it's balanced out by the performance of others, which reduces your overall risk. This diversification is one of the key strengths of index funds, as they allow you to own a broad swath of the market without having to buy each individual stock or bond yourself. But it's not just about spreading your bets. Index funds are also incredibly cost-effective. Here's why. Actively managed funds, where a manager picks and chooses investments, often come up with high fees. You're paying for the expertise and time of the manager, but as we mentioned earlier, the odds of them consistently beating the market are very slim. With index funds, the goal isn't to outperform the market, it's to match it. Because of this passive approach, simply mirroring an index rather than trying to outsmart it, index funds typically have much lower expense ratios. These lower costs can have a massive impact on your returns over the long term. Consider this, even a small difference in fees can add up to thousands, if not tens of thousands of dollars over decades of investing. Index funds keep more of your money working for you rather than lining the pockets of fund managers. Now let's talk about performance. You might be wondering, if index funds are just matching the market, aren't I just missing out on potential gains from the next big stock? It's a fair question, but here's reality. Trying to pick the next big winner is a very risky game that most investors, even professionals, don't win. On the other hand, the stock market as a whole has historically returned an average return of around 10% over the long term. By investing in an index fund, you're tapping into that consistent growth without having to gamble on which individual stocks might do well. And finally, let's not overlook the simplicity of index funds. Investing can feel overwhelming with a barrage of information and choices that can paralyze even the most confident investor. Index funds offer a refreshingly straightforward solution. There's no need to constantly monitor your portfolio, analyze earnings reports, or stress over market fluctuations. You can invest with confidence knowing that your fund is designed to follow the market's natural ups and downs, and over time grow alongside it. In summary, index funds are a powerful tool for investors at any stage of their journey. They offer broad diversification, low costs, reliable performance, and a level of simplicity that makes them easily accessible to everyone. Whether you're looking to build wealth for retirement, save for a major purchase, or simply grow your financial security, index funds provide a proven, stress-free path to achieving your goals. As we continue, we'll dive deeper into specific examples of index funds that you can consider adding to your portfolio and how they can fit into your overall investment strategy. Now that we've laid the foundation of why index funds are such a powerful investment tool, let's dive into some specific examples. These aren't just any index funds. These are some of the most popular, widely held funds that can serve as the building block of a strong, diversified portfolio. We'll explore how each one works, what makes them unique, and why they might be a great fit for your retirement strategy. The first one is S&P 500 Index Fund. Some examples are VOO, SPY, SPLG. The S&P 500 fund is often referred to as the cornerstone of index investing. This type of fund tracks the S&P 500 index, which comprises 500 of the largely traded public companies in the United States. These companies in this index represent a diverse array of industries, including technology, healthcare, financials, consumer goods, and much more. Because these companies are among the most successful and stable in the U.S., investing in an S&P 500 index fund offers exposure to the overall performance of the U.S. economy. Popular examples include VOO, or the Vanguard S&P 500 ETF. The expense ratio is one of the lowest in the industry at just 0.03%. This means for every $1,000 you invest, you're only paying 30 cents per year in fees. The performance over the last decade, VOO has closely monitored the performance of the S&P 500, delivering an average return annually of about 10%, which is right in line with the historic average of the index. Lastly, dividend yield. VOO pays a modest dividend, typically around 1.5 to 2%, providing a small stream of steady income on top of the capital appreciation. Another example is SPY, or the SPDR S&P 500 ETF Trust. The expense ratio is slightly higher than VOO at 0.09%, but still very competitive. It has much more liquidity than VOO. SPY is one of the most highly traded ETFs in the world, meaning that it has very high liquidity. This makes it easy to buy and sell shares with minimal price impact, which is a crucial factor for both long-term investors and short-term investors. And it has history. The SPY was the first ETF ever created, which was launched in 1993, and it has a long track record of performance. So why should you consider an S&P 500 index fund? The first reason is diversification. With just one investment, you're getting exposure to over 500 companies across various sectors. This diversification reduces risk while still allowing you to participate in the growth of the U.S. economy. The second reason is stability. The companies in the S&P 500 are established and have significant impact on the market. This makes an S&P 500 index fund less volatile than the funds that are focused on much smaller, more speculative companies. And the third reason is it's a core holding. Many investors use an S&P 500 fund as the core of their portfolio, building around it with other investments that complement its strengths. Secondly, we're going to look at total stock market index funds, for example, VTI. While the S&P 500 fund focuses on large cap stocks, a total stock market index fund gives you exposure to the entire U.S. stock market, including large, mid, and small cap companies. This broad scope means that you're not just investing in the giants of the industry, but also in the potential growth stories of smaller and mid-sized companies. It's an even more diversified approach, capturing the full spectrum of U.S. corporate performance. So a popular example of a total index market fund is VTI, or Vanguard Total Stock Market ETF. The expense ratio is very low at just 0.03, making it incredibly cost efficient. Coverage: VTI holds over 4,000 stocks, providing comprehensive exposure to the U.S. equity market. This includes everything from Apple to Microsoft to smaller companies that you might not have even heard of, but are just part of the large engine driving U.S. growth. Next is performance. Historically, VTI has delivered returns similar to the S&P 500, but with the added benefit of exposure to mid and small cap stocks, which can sometimes have higher growth potential. Lastly, the dividend yield. Similar to S&P 500 funds, VTI offers a dividend also, although it's slightly lower due to the inclusion of smaller companies that may reinvest their earnings rather than paying regular dividends. So why consider a total stock market index fund? It has even broader diversification. With exposure to thousands of companies, you're spreading your investment across a wider array of opportunities. This reduces risk even further while capturing the growth of smaller companies that aren't even in the S&P 500. Next reason is simplicity. If you're looking for a one-stop shop to invest in the entire US market, VTI is a straightforward, low-cost solution. Lastly is growth potential. By including mid and small cap stocks, you offer the potential for higher growth, as smaller companies often have more room to expand. The next example of index funds is international index funds, for example, VXUS. While investing in US companies is a great strategy, it's often important to remember that the global economy is vast and full of many opportunities. International index funds give you exposure to companies that are outside the US in other countries, providing global diversification. These funds include companies from developed markets like Europe and Japan, as well as emerging markets like China, India, and Brazil. A very popular example of an international fund is VXUS, or the Vanguard Total International Stock ETF. It has a low expense ratio of 0.11%, especially considering the fund's broad international exposure. It has a lot of coverage. VXUS includes over 7,000 stocks in all countries around the world. This includes companies from both developed markets like Nestle in Switzerland and Toyota in Japan, and emerging markets like Alibaba in China. It has great performance. International markets can be more volatile than the US, but they also offer opportunities for growth in different economic environments. VXUS has delivered solid returns, particularly during periods when non-US markets have outperformed. It has a very good dividend yield. International stocks typically tend to pay higher dividends, and VXUS typically offers a yield of about 2 to 3%. So why consider an international index fund? The first reason is global diversification. By investing in VXUS, you're not just tied to the US economy. This can help protect your portfolio against downturns in the US market and allows you to benefit from growth in other regions. The second reason is currency diversification. By investing internationally, you also diversify your currency exposure, which can be a hedge against fluctuations in the US dollar. And lastly, it's a complement to US investments. VXUS pairs well with a US-focused fund like VTI or VOO, providing a more balanced global portfolio. And the last example of an index fund are bond index funds, for example, BND. As you approach retirement, preserving your wealth becomes as important as growing it. That's where bond index funds come in. Bonds are typically less volatile than stocks and provide a steady stream of income, making them essential as a part of a well-rounded retirement portfolio. A bond index fund like BND offers exposure to a wide range of bonds, including U.S. Treasuries, corporate bonds, and government-backed securities. A very popular example of a bond market ETF is BND, or Vanguard Total Bond Market ETF. The expense ratio is a low 0.03%, making it a very affordable way to gain exposure to the entire US bond market. It has a lot of coverage. BND holds thousands of bonds across different sectors, including government bonds, high-quality corporate bonds, and mortgage-backed securities. It has good performance. While bond returns are typically lower than stocks, they also provide stability and income, which are crucial during market downturns. BND has historically offered steady returns with lower volatility. Lastly, it has good yield. Bonds pay interest, and BND typically offers a yield in the range of 2 to 3%, depending on the interest rate environment. Right now, the interest rate's kind of higher, around 5%. Why consider a bond index fund? The first reason is stability. Bonds are less volatile than stocks and can help protect your portfolio from market swings, especially as you near retirement. The second reason is income generation. The interest income from bonds can provide a steady cash flow, which is particularly a valuable investment in retirement when you might need to draw down your investments. The last reason is diversification. By adding bonds to your portfolio, you help balance the higher risk of stocks by creating a more stable overall investment strategy. These 4 index funds, VOO, VTI, VXUS, and BND, represent the core components of a diversified, well-rounded investment portfolio. By combining these funds, you can capture the growth of the US and global stock markets, while also ensuring stability and income through bonds. Whether you're just starting out or looking to optimize your existing investments, these funds offer a simple, cost-effective way to build your portfolio over the long term and achieve financial freedom in retirement. In this next section, we'll discuss how to put these pieces together into a comprehensive retirement strategy, tailoring your asset allocation based on your age, risk tolerance, and financial goals. Now that we've explored some of the most effective index funds available, it's time to put all that together and discuss how to build a robust retirement portfolio. The key to a successful retirement strategy isn't just about picking the right index funds, it's about creating a well-balanced, diversified portfolio that aligns with your goals, risk tolerance, and timeline. In this section, we'll walk you through the process of constructing a retirement portfolio using index funds, from understanding asset allocation to managing your investments as you approach and enter retirement. The first part is understanding asset allocation. What is asset allocation? Asset allocation refers to how you divide your investment portfolio among different asset classes, such as stocks, bonds, and cash. It's one of the most crucial factors in determining both the risk and return of your portfolio. The right asset allocation depends on several factors, including your age, risk tolerance, and retirement goals. A common rule of thumb is the 100 minus your age rule. This guideline suggests that you should subtract your age from 100 to determine the percentage of your portfolio that should be invested in stocks. The remaining percentage would be allocated to bonds. For example, if you're 40 years old, you might have 60% of your portfolio in stocks and 40% in bonds. However, this is just a starting point. Many financial advisors now recommend using a 110 or even 120 minus your age, especially given the longer life expectancies and potential need for growth even in retirement. Your risk tolerance, how comfortable you are with the ups and downs of the market, also plays a crucial role. If you're more risk averse, you might want to allocate more to bonds, which are less volatile. Conversely, if you're more comfortable with taking on more risk for potentially higher returns, you might lead more into stocks. Your time horizon, or the number of years you need until you start withdrawing from your retirement accounts, is another important consideration. The longer your time horizon, the more risk you can typically afford to take, as you have more time to ride out market volatility. Part 2 is constructing a diversified portfolio. Let's break down how to build a diversified portfolio using the index funds we discussed earlier. An S&P 500 index fund like VOO, a total stock market index fund like VTI, an international stock market fund like VXUS, and a bond index fund like BND. We'll go through different scenarios based on various stages of life and retirement planning. Early career, ages 20 to 35. At the beginning of your career, time is on your side. You have decades to invest and recover from any market downturns, which means that you can afford to take on more risk. Here's a sample asset allocation. 70% stocks, VTI or VOO. At this stage, you can lean heavily into stocks to maximize growth. A total stock market index fund like VTI gives you broad exposure to the US market, including large cap, mid cap, and small cap companies. Alternatively, an S&P 500 index fund, VOO, focuses on large cap stocks, which are generally more stable but still offer growth potential. 20% international stocks, VXUS. Diversifying globally is key, even in your early career. Allocating a portion of your portfolio to an international stock market fund like VXUS allows you to tap into growth opportunities outside the US, potentially benefiting from emerging markets and different economic cycles. 10% bonds, BND, while your primary focus is still on growth. A small allocation of bonds can provide some stability. A bond index fund, BND, offers a buffer against stock market volatility, which can be reassuring, especially in strong market downturns. The second part of life, mid-career, ages 35 to 50. As you progress in your career, you might want to start thinking more seriously about retirement. While growth is still important, you may want to start to begin balancing it with some added stability. 60% stocks, VTI or VOO. Continue focusing on growth, but consider shifting some of your investment from small cap stocks to more stable large cap growth stocks if you haven't already. The total stock market fund, VTI, still offers broad exposure, or you can concentrate on more large cap stocks with the S&P 500 fund or VOO. 20% international stocks, VXUS. Maintain your international exposure as global diversification remains important. International markets can sometimes outperform US markets, and having this exposure can enhance your portfolio's overall performance. Lastly, 20% bonds, BND. By increasing your bond allocation, you add more stability to your portfolio as you start to think about preserving your wealth. Bonds provide a steady income stream and are less volatile than stocks, helping you to protect your portfolio from major downturns. The third part of life, pre-retirement stage, ages 50 to 65. As retirement approaches, your entire focus should shift from growth to preserving the wealth that you've accumulated. You'll likely want to reduce risk and start planning for more income generation. 40% stocks, VTI or VOO. Reduce your exposure to stocks as you near retirement, focusing more on large, stable companies. The S&P 500 Index Fund, or VOO, is ideal here, offering the potential for continued growth while still reducing overall exposure to the more volatile small cap segment. 20% international stocks, or VXUS. Keep some exposure to international stocks, but you may want to consider reducing this a little bit if you're more comfortable with US-focused portfolio. International stocks can still offer growth and diversification, but you'll want to manage risk as you get closer to needing your funds. 40% bonds, BND. Significantly increase your bond allocation. Bonds will still play a crucial role in protecting your portfolio from market downturns and also providing a steady stream of income during retirement. The Vanguard Total Bond Market ETF, or BND, offers a comprehensive mix of government and corporate bonds. The last stage of life, which is retirement, ages 65 plus. Once you're in retirement, the goal is to generate income and preserve your wealth to last throughout the retirement years. Your asset allocation should reflect the shift. 30% stocks, VTI or VOO. While you'll still want some exposure to stocks to keep up with inflation and potentially grow your portfolio, it's crucial to reduce your risk. An S&P 500 fund or VOO is suitable here, as it provides growth potential for relatively lower volatility compared to smaller stocks. 10% international stocks or VXUS. Maintain a small allocation to international stocks for diversification, but make sure to minimize it to reduce risk. At this stage, stability is more important than chasing high returns. Lastly, 60% bonds or BND. Bonds should make up the majority of your portfolio in retirement. The income generated from bonds can help cover living expenses, and the stability that they provide will help preserve your wealth. A bond total market index fund, or BND, gives you the broad exposure to the bond market, ensuring a steady stream of income. The third part is managing your portfolio over time. By building a retirement portfolio, it isn't a one-time task, and it requires ongoing management to ensure that it stays aligned with your goals and risk tolerance. Here's how to manage your portfolio over time. The first part is regular rebalancing. Rebalancing is the process of adjusting your portfolio to maintain your desired asset allocation. As the value of your investments change, your portfolio can drift away from your target allocation. For example, if stocks perform really well, they might grow to represent a larger portion of your portfolio than intended, which is increasing your risk. To rebalance, you would sell some of the overperforming assets like stocks and buy more of the underperforming ones like bonds to return to your target allocation. Many financial advisors recommend rebalancing at least once a year or whenever your allocation drifts more than 5% from your target. However, that's totally up to you. By adjusting your rebalancing, you're actually cutting from the winners and adding to the losers. So it's totally up to you what you do in regards to rebalancing. The second part is adjusting your allocation as you age. As you age, your risk tolerance and investment goals will change, and your asset allocation should reflect that. Typically, you want to gradually shift your portfolio towards more conservative investments like bonds as you get closer to retirement. This process is sometimes referred to as glide path investing, where your portfolio becomes more conservative over time to reduce risk as your retirement date approaches. If you're using a target date fund, this reallocation happens automatically as the fund is designed to adjust its allocation as you near retirement. However, if you're managing your portfolio manually, you'll need to make these adjustments yourself or work with a financial advisor to do so. Next is income generation in retirement. Once you've retired, your focus shifts from growth to income generation. You'll need to determine how much income you can safely withdraw from your portfolio each year without running out of money. A common rule of thumb is the 4% rule, which suggests withdrawing 4% of your portfolio's value each year in retirement. This rate is considered sustainable for a 30-year retirement, though your actual withdrawal rate may actually depend on your specific circumstances and market conditions. Bonds will play a key role in generating income during your retirement, but you might want to also consider other income-generating investments like dividend-paying stocks or REITs. Additionally, setting up a systematic withdrawal plan with your brokerage can help automate the process and ensure that you're sticking to your income strategy. The last thing for consideration is taxes. Taxes are an important consideration when managing your retirement portfolio. Depending on the type of accounts that you hold, for example, a traditional IRA, Roth IRA, or taxable brokerage account, your withdrawals and income may be subject to different tax treatments. Tax-advantaged accounts like traditional IRAs or 401ks, withdrawals from traditional retirement accounts are taxed as ordinary income. It's important to plan your withdrawals strategically to avoid pushing yourself into a higher tax bracket. Roth accounts like Roth IRA or Roth 401k. Withdrawals from Roth accounts are tax-free in retirement, making them a valuable tool for managing your tax liability. If you anticipate being in a higher tax bracket in retirement, prioritizing contributions to a Roth IRA during your working years can be beneficial. Lastly, taxable accounts. Dividends, interest, and capital gains in taxable accounts are subject to taxes in the year that they're earned. Managing your investments to minimize capital gains taxes, such as by holding investments for longer than a year to qualify for long-term capital gains, can help reduce your tax bill. Working with a tax advisor or financial planner can help you develop a tax-efficient withdrawal strategy that maximizes your retirement income while minimizing your tax burden. While index funds make investing simple and accessible, the process of building and managing your retirement portfolio can still be very complex, especially as your financial situation changes over time. Working with a financial advisor can provide personalized guidance and help you navigate the nuances of retirement planning, including tax strategies, withdrawal planning, and adjusting your asset allocation as your needs evolve. A financial advisor can help you keep track during turbulent market conditions, providing reassurance and helping you avoid emotional-based decision-making that could derail your retirement plans. So in conclusion, building a retirement portfolio with index funds offers a straightforward and cost-effective way to achieve financial security in your golden years. By understanding asset allocation, diversifying your investments across different types of index funds, and managing your portfolio over time, you can create a robust strategy that really aligns with your goals and risk tolerance. Whether you're just starting out or already in retirement, the principles of index investing can help you build and maintain a portfolio that supports a comfortable and worry-free retirement. If you found this video helpful, please be sure to give it a thumbs up, and don't forget to subscribe for more personal finance and investing tips. Leave a comment down below if you have any questions or if there's a specific topic you'd like me to cover in a future video. Thanks for watching, and I'll see you in the next one.